In the grand theatre of financial markets, the most challenging and costly performance is the final act, the exit. Any person can summon the courage to purchase a stock, to stake a claim on a future they envision. But recognizing the precise moment to sell that is an art form, a discipline that has eluded the vast majority who have attempted to master this game. The typical trader exists in perpetual torment, caught between two equally destructive forces. Either they seize a modest profit prematurely, consumed by terror that their meager gains will disappear, or they cling to a winning position long after its peak, frozen by avaricious fantasy, observing in distress as a magnificent paper fortune dissolves back into the merciless void of the marketplace. This singular, universal inability to master the exit constitutes the principal source of all speculative destruction. The legendary master speculator understood this challenge not as chance or conjecture, but as a fundamental defect in human psychology. He recognized that the amateur exits not when market conditions dictate, but when emotions command. They sell from fear or maintain positions from hope. His entire career represented an unrelenting pursuit to eliminate these treacherous human elements from operations. He endeavored to replace emotional impulse with cold, calculated, mechanically precise rules. For him, the optimal exit point was never a price to predict at the summit, but a condition to identify a signal from the market itself indicating the moment for action had materialized. He grasped that substantial wealth in speculation came from recognizing major trends and possessing the fortitude to follow them. Yet this fortitude was not blind obstinacy. It was intelligent patience, reinforced by knowledge that his system would deliver clear, unambiguous signals when the trend concluded. He never attempted to capture the final fraction of movement. A foolish pursuit, he knew, had cost traders fortunes. His concern centered solely on capturing the significant central portion of the move and, most critically, preserving the profits secured. To achieve this, he developed and maintained three foundational exit principles, a strategic trinity forming the defensive cornerstone of his entire trading philosophy. The first great exit principle was the most immediate and crucial for capital preservation. A trade must demonstrate profit from inception or be abandoned immediately. This was not merely suggestion, it was inviolable law. When initiating a position at a critical pivotal point, a moment believed to mark the beginning of a major move, the entry served as a test of judgment. The market's immediate reaction delivered the verdict. If a purchased stock began advancing, judgment was confirmed. However, if it stagnated or declined, the market communicated unequivocally that timing was incorrect. There would be no waiting for small initial losses to expand, no allowing trades time to work themselves out, no hoping for reversals. The exit would occur immediately and without emotion. This embodied a principle eluding 90% of traders. A position not feeling right from the beginning should not be held. The first loss remains always the smallest, and best loss a modest price for invaluable information that one stands on the wrong side of the market at that particular moment. The average speculator operates exactly opposite. Small initial losses don't trigger caution, they trigger hope and often the fatal impulse to average down. They purchase more, believing they're improving their position. In reality, they're reinforcing error, compounding mistakes, transforming small, manageable losses into potentially catastrophic ones. This behavior represents what it truly is, an act of ego, a refusal to acknowledge mistakes. The professional speculator cannot afford such vanity. They must accept the market's verdict and act accordingly. Their primary duty is capital protection, and this rule constitutes their first and most powerful defensive line. The second exit principle was designed to protect substantial profits accumulated during major trends. It served as the method for identifying movement exhaustion. The rule stated, after a natural reaction, the stock must resume its advance and establish a new high. Failure to do so constitutes a definitive sell signal. A healthy bull trend exhibits distinct rhythm, a series of upward thrusts, followed by periods of normal, healthy pullback on lighter volume. These reactions signify not weakness but strength, moments for the market to consolidate gains before the next advance. Intelligent patience meant sitting through these normal reactions, understanding they were part of the game. They could be observed without alarm. but focus remained on what transpired after reaction completion. Did the stock rally with renewed vigor? Did it absorb profit-taking and attract fresh buying power? Most critically, did it possess strength to push through its previous high point and continue the primary trend? If answers were affirmative, positions were held with confidence. But if the rally following reaction proved feeble, stalling below the previous peak or failing to materialize entirely, it represented an unmistakable danger signal. It indicated that great buying power propelling the trend had exhausted itself. Upward force was spent. The line of least resistance no longer pointed upward. Remaining in position at this juncture risked surrendering all patiently accumulated profits. It was time to sell, not from guessing at the top, but because the market's own behavior had signaled the advance's conclusion. This rule transformed profit-taking from an emotional, fear-based decision into a logical, signal-based action. The third and final exit principle was the most mechanical and unemotional of all the ultimate non-negotiable boundary. Violation of a previous pivotal point against the position. This constituted definitive confirmation that a major trend had reversed. In upward trends, the low point of the last natural reaction becomes a critical support level, a lower pivotal point. This point represents the final defense line for the bull trend. As long as price remains above it, the trend, while potentially weakening, remains unbroken. However, the moment a stock declined and decisively broke below that previous reaction low, it represented a signal of highest order, the market's own declaration that sellers had finally overwhelmed buyers, that the primary trend had shifted from up to down. There existed a specific mathematical definition for this break. The stock had to pierce the old pivotal point by a margin of at least 3 points. It was significant, confirmed breach of support.